Chapter 1: The Catalyst. 09:31 Tokyo, Monday, 9 March 2026. Finance Minister Taniguchi steps back from the podium as the screen behind her freezes. Bid cover 0.97, weighted average yield 0.892%, tail 18 basis points. For the first time since 1955, a benchmark 10-year JGB auction fails. Japan's Ministry of Finance is left with 2.4 trillion of unsold paper, an amount larger than the annual defense budget. Within 30 seconds, the Tokyo OTC swap rate jumps 42 BP, exceeding the single-day surge that followed the 1995 Kobe earthquake. By 09:33, the electronic boards at the Bank of Japan's hulking glass facade flicker red. The 30-year yield breaches 1.8%, double the level at which the Government Pension Investment Fund's internal stress test shows negative net equity. Inside the BOJ's fifth-floor crisis room, Governor Yuda's deputy scrolls to slide 17. Assuming a 200 BP parallel shift, our DV01 exposure equals 167% of Tier 1 capital. No one speaks. The figure means the world's third-largest central bank would be technically insolvent if it had to mark its JGB book to market. At 09:35, Reuters headlines cross the fiber-optic cables lying 80 m below the Pacific. Japan bond auction fails. In London, it is 00:37. Algorithmic funds that harvest sleep hours, volatility dump 10-year gilts. The long end richens 28 BP in 8 minutes. At 00:46, the Bank of England's overnight gilt yield curve model prints a 4.6 sigma move, breaching the threshold that forced the 2022 LDIs into mass leveraged liquidation. Across the Atlantic, the New York Fed's markets desk is still dark, but Chicago futures are open. By 18:47 Chicago time, the CME Ultrabond has limit down 4 points. Inside the Fed's own risk monitor, software called SDIRMAP, yellow turns crimson. Probability of simultaneous G7 bond market impairment, 0.8 right arrow 42%. No human has yet lifted a telephone. The fracture is propagating at clock speed. At 09:52 Tokyo, the Nikkei is limit down. Circuit breakers freeze equity futures, but the cash market for yen keeps trading. USD JPY punches through 180, a level not seen since the 1985 Plaza Accord. Implied one-week yen volatility spikes to 96%, higher than during the 2011 tsunami. By 10:00, every major Japanese life insurer is margin called on its cross-currency swaps. They need dollars today, not tomorrow. The Bank of Japan fires off an emergency request for $60 BN through the Fed's FIMA repo facility, established in 2020 to prevent foreign dollar shortages. But this Monday, the request is queued behind a similar plea from the ECB. Europe's banks must roll $94 BN of 3-month commercial paper at noon New York time, and the European money market has frozen. At 10:03, the world's two largest central banks are simultaneously asking the Federal Reserve for more dollars than the FIMA limit allows. Inside the Fed's 9th floor boardroom, Chairman Bowman stares at the terminal. FIMA utilization, $195 BN/$200 BN authorized. The remaining $5 BN is a rounding error for a single Chinese city commercial bank. At 10:04, the unthinkable becomes data. A simultaneous failure of primary bond markets across Japan, Germany, the United Kingdom, France, Italy, Canada, and the United States. The G7 is no longer a club. It is a chain letter of insolvency. History records none of this in its ledgers yet, but the ledgers themselves are about to burn. Inline photograph. Children in 1923, Weimar Germany stacking worthless banknotes like toy bricks. The scene has happened before. The camera merely waits for the next republic. Chapter 2, The First Ripple. 1112 Tokyo. The BOJ's balance sheet holds 532% of GDP in government debt, more than double the peak reached by the Banque de France in 1924, before the franc's 80% devaluation. Governor Yuta cancels the scheduled yield curve control purchases and instead announces unlimited, fixed-rate buying at 0%, a phrase last used by the Reichsbank in April 1923, 2 months before inflation crossed 50% per month. At 11:15, the yen plunges another 8%. Japanese import price indices leap 6% in 15 minutes, the fastest move on record. In Frankfurt, the ECB's Marguerite Fund, created in 2022 to sterilize PEPP holdings, receives a margin call of €38 BN. The fund's collateral, Italian BTPs, now pricing 340 BP over bunds, a spread that in 2011 triggered the fall of Silvio Berlusconi. At 06:17 Frankfurt time, Christine Lagarde authorizes a snap €750 BN of additional PEPP reinvestments, but the Bundesbank's internal voting rules require unanimous consent, Dresden and Stuttgart object. For 90 minutes, Europe's central bank is paralyzed, while Rome's bonds gap lower. At 00:48 New York, the CME raises silver and copper margins by 50%, the first commodity exchange to react. By 01:00, the 3-month cross-currency basis for euros versus dollars reaches 178 BP, a level that in 2008 forced the Fed to open swap lines worth $500 billion. This time, the Fed's board is split. Governor Jefferson tweets from a monetary policy conference in Jackson Hole. "Swap lines are a moral hazard narcotic." The sentence is deleted after 30 seconds, but the internet never forgets. Eurodollar liquidity futures fall another 3%. At 01:09, the Reserve Bank of Australia announces a $10 BN US dollar repo, less than the daily swing in Apple's cash balance, yet the largest in its history. Inside Toronto's C$550 BN Canada pension plan, risk engines trigger forced selling of foreign equities. The model requires 28% cash by 06:00 local time. At 01:14, S&P futures are limit down 7%. Nasdaq margin calls wipe out $180 BN of leveraged ETF exposure before breakfast. By 02:00 London, UK defined benefit pension funds receive their 6th collateral call since midnight. LDIs must post an extra £42 BN before the FTSE opens. The Bank of England repeats its 2022 playbook, buying long gilts at whatever price. Yet today the offer is greeted with silence. Nobody wants sterling, everyone needs dollars. At 02:17, the BOE activates the Fed's $100 BN swap line. The draw is 93% within 11 minutes, faster than the 2020 COVID dash. Across the ocean, the New York Fed's Markets Group convenes an emergency call at 03:00. Chairman Bowman asks for a number. How big is the global dollar short? The staff reply, best estimate, $13.02 TRN, roughly 60% of offshore bank assets. The room falls quiet. That is larger than the entire U.S. money market fund industry. At 03:05, the Fed issues a terse statement. FIMA limits are today suspended. A single sentence reopens the monetary sluices first carved in 1962 after the Cubana Missile Crisis. But confidence, once cracked, behaves like supercooled water. It freezes the instant you touch it. By 03:30, every major sovereign debt dealer has withdrawn bids. The G7 primary market machine stops. Governments that must roll $7.04 TRN of debt in the next 12 months now face an empty order book. The sun rises over Asia again. Nobody cheers. Chapter 3: The System Shock. Day 5. The IMF's internal surveillance note, leaked to Bloomberg at 04:00 Washington time, warns that velocity of money in the United States has jumped from 1.4 to 2.9 in a week, a pace last seen in Germany in October 1923, when prices doubled every 3.7 days. In Tokyo, the Cabinet Office's titanium-clad CPI model prints 14% for the month, annualized 288%, but the ministry delays release, citing data check protocols. A convenience store chain in Osaka raises the price of a rice ball from 110 to 180 between breakfast and lunch. Television anchors call it seasonal adjustment. By day 8, the European Commission's flash estimate for the Euro area harmonized index shows 6.3% month-on-month. The Bundesbank whispers to Berlin that the true figure is closer to 11%. In Rome, the government orders price freezes on 150 staple goods. Supermarket shelves empty within 24 hours. The Venezuelan choreography replayed in the heart of Europe. Photograph: empty shelves in Caracas, January 2018. Caracas once, Rome twice. The camera does not care for passports. Day 12. The Bank of Canada abandons its 2% inflation target. Governor Macklem tells Parliament price stability is secondary to financial stability operations. The phrase mirrors the Reichsbank President Rudolf Havenstein in August 1923. Collapsing credit endangers the Reich more than rising prices. Day 15. The Fed's Beige Book records anecdotes of wage payments made in prepaid debit cards because corporate payroll systems cannot reprice fast enough. The parallel is Hungary 1946, when factory foremen paid workers twice per shift to outrun the Pengo's fall. Day 18. Gold fixes in Shanghai at $4,280 Oz, double the London morning fix, while Bitcoin clears $180 on Korean exchanges, a 240% premium to Coinbase. Currency bifurcation has arrived. Day 21. The yield on Italy's one-year bills touches 18%, the same level that forced the lira out of the exchange rate mechanism in 1992. But this time, there is no devaluation valve. Italy no longer prints its own money. Day 25. Japan's government legislates a compulsory 10% wage hike for all workers, an exact replay of the Weimar Indexierungsgebot of October 1923, designed to keep labor peace. Instead, it accelerates the flight from currency. Day 28. The G7 finance ministers hold a Zoom call. The communiqué promises coordinated fiscal support. Markets sell the news. The euro drops 4% in 20 minutes. Economists on Twitter coined the term Friedman's revenge. The velocity genie cannot be rebottled once the public expects tomorrow's prices to be higher than today's. By the end of the first month, every G7 CPI exceeds 50% at an annualized rate. The academic definition of hyperinflation is no longer a debate. It is the baseline. Chapter 4: The New Order. Month 3. Washington passes the Price Stability Act, criminalizing the sale of goods at more than 110% of the reference price, posted on a new government app. Enforcement officers, dubbed price sheriffs, scan QR codes in Walmart and Safeway. Violations carry a 20-year sentence. Black market butter trades for $24 a pound, 6 times the official tag. Neighborhoods resurrect the ration card. printed on cardboard last used in 1945. Month 4. The ECB launches the digital euro wallet with a personal spending cap of €10 per month for basic goods. To unlock more, citizens must upload proof of vaccination, tax compliance, and a social credit score. An underground exchange immediately forms. 10 digital euros swap for 400 paper euros, or 0.03 Bitcoin. The state's unit of account has become a coupon. In Canada, the Mounties arrest 17 truckers for unauthorized barter after they exchanged diesel for food in Alberta's oil sands. The charge is economic terrorism. Month 5. Japan introduces the new yen, at a conversion rate of 1 yen for every 10 old yen. Banks limit withdrawals to 50 yen per household, enough for 2 weeks of groceries if you accept the official price list. The move copies the 1946 pengo to forint conversion that wiped out 97% of Hungarian savings overnight. Photographs show elderly Takyawites queuing with abacuses to calculate what pensions are worth. Month 6. The United Nations Security Council convenes on food riots. France deploys the Foreign Legion to Marseille, where supermarket looting leaves 12 dead. Goldman Sachs circulates a private client note estimating that 38% of global GDP now transacts outside formal banking, an all-time high. Month 7. The Bank of England secretly negotiates with Switzerland to accept physical gold as settlement for clearinghouse obligations. London's old vaults, unused since 1971, are released. Month 9. A bipartisan U.S. bill proposes a 100-year Liberty Bond, paying no coupon but indexed to population growth, an explicit acknowledgement that the debt will never be repaid in real terms. The proposal mirrors the 1923 German Milliardanleihe that promised salvation through eternity. Month 12. G7 leaders meet in a decommissioned grain silo outside Winnipeg. The communique is handwritten on cardboard because printers cannot source ink. They agree to study a new global currency unit backed by a basket of electricity, wheat, and semiconductor wafers, but no timetable is set. Behind closed doors, IMF staff draft the Winnipeg Accord, a plan to haircut all sovereign debt by 30% in real terms, then redenominate the remainder in banker, accounting units first proposed by Keynes in 1944. The public is told nothing. Markets everywhere are closed for holiday technical adjustments. A reporter from Nairobi tweets a photograph of delegates burning draft pages to stay warm. The image is deleted within minutes, but the archive servers at the Wayback Machine keep it forever. The new order has arrived, cloaked in frost and silence. Chapter 5: The Legacy. Year 3. World trade measured in US dollars is 62% below the 2025 peak. Container shipping from Shanghai to Rotterdam costs the same in digital euros, but the euro itself buys 45% fewer chips from TSMC. The WTO rebenchmarks everything in kilowatt hours. Money becomes a claim on energy, the only unit traders trust. Year 5. Japan's population falls below 120 million for the first time since 1952. Economists attribute half the decline to emigration of young professionals who left when salaries turned into teleporting mirages, paid daily at 16:00 and worthless by dusk. Italy's Mezzogiorno returns to a barter economy. Landowners in Puglia trade olive oil for medical services because the national health card system cannot update prices fast enough. Year 7. The United States passes the Jubilee Act. All federal student loans, auto loans, and credit card balances below $75 are canceled by decree. The Fed simply credits banks with fresh reserves, expanding its balance sheet to 180% of GDP, 3 times the Reichsbank's ratio in 1923. Inflation momentarily drops to 9%, then reaccelerates as households spend the freed cash on anything tangible. Year 10. A new conference is held at the Mount Washington Hotel in Bretton Woods, the same granite pile where the post-1944 order was forged. Delegates arrive by electric bus because jet fuel is rationed. Nameplates are written in 4 languages, but gold is the lingua franca. The final treaty, signed at 03:00 on 21 December 2036, creates the Global Clearing Unit, GCU, backed 40% by gold, 30% by carbon tons, and 30% by a basket of semiconductor indices. Each G7 currency is repegged to the GCU at a fixed rate, but citizens may only convert 5% of annual income. The rest must stay inside domestic digital ledgers programmable by the state. Capital controls are enforceable by smart contract code. Violation triggers wallet freeze. The decade of hyperinflation has ended not with sound money, but with money you are not allowed to move. Demography is the final ledger. Japan has lost 9 million residents. Italy's median age tops 50. The United States records the lowest birth rate since records began in 1909. History's lesson is carved in the granite. When trust in the measuring rod disappears, societies do not revert to barter. They revert to borders, tribes, and time. The G7's 50-year hyperinflation is over. The silence that follows is the sound of a tape measure snapping, never to be mended.